Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect. But there is a job here for us to do in better aligning demand with supply.
My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other two agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
as quickly as possible.
Yes, but it will be some months.
Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part that we'll keep capital requirements strong.
How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk. Lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the whole crypto space, and that they give us prior notice. And we've issued, along with the FDIC and the OCC, a number of notices to that effect.
Will you commit that any ongoing capital review by the Federal Reserve will follow the law, and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all?
Yes, I can easily commit to that. We're very strongly committed to tailoring, and that'll be, I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have that I believe that we have, but I would agree with your statement.
Do you believe that you currently have the monetary policy tools to actually reduce inflation? Wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
Senator, not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
If there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy-induced or whether it is a matter of a shortage in supplies from outside or whether it's war-related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense, it is, but I would just say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
The fact that you've been increasing you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the use of the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Mr. Chairman, would you say that it is a truism that the United States dollar is the reserve of choice in the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
So I guess I will start, if I can, by saying that these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse, and could do longstanding harm.
Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, is it fair to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance sheet, the shrinkage of the balance sheet will continue too, but it's principally rate hikes.
So the question is, when does that part of doing anything necessary to tame inflation, come into conflict with your other mandate of maximum employment?
Not now, when we have the lowest unemployment in 54 years, and where we have a labor market that is extremely tight, extremely. So, but in that time could come, but it really isn't now, where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so, if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly.
You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not
the
wages,
you're trying to
or
raise the unemployment rate.
There are a lot,
And
so there are a lot of.
that mean I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels, like, for example, just job openings.
You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. In order to reduce inflation by 2%, unemployment had to go up 3.6%. Now, that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the
Okay.
Fed has tried to reduce
Now,
inflation.
right now, the current inflation rate 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2%, based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
But the more we help on the fiscal side, the fewer people you're going to have to put out of work. Isn't that a fact?
Please answer.
It could work out that way.
Sir?
It could work out that way.
Yes, sir. Thank you.
extent did that disruptive supply chain contribute to inflation, and to what extent will the new, if you envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak of inflation was all about spending on goods where people couldn't spend on services. So goods spending went way up, and the global supply chain, many goods are imported. The global supply chain just collapsed, and that was the source of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply chains. That's where the challenge is now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. Our monetary policy tools are famously powerful but blunt.
Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and the CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary policy?
Well, it would be very significant, but I have to say we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
But the impact on increased interest rates are usually felt more by low to moderate income people. Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without a softening in the labor market, without a rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before, like the war in Ukraine, like the supply chains that you mentioned. Right. So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
So I'd say a couple things to that. First, we're going to be looking at inflation in the three sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector. And we need the inflation that's already underway in the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that if monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation. So we're watching carefully to see those effects come into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
But if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. But we are very focused on what we call core inflation, because that is what is driven by really by demand, and our tools are really aimed at demand.
If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs. Yes. That would be great, because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game. But it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will, at the margin, provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side, and I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one seems to be more unique in nature, and how are you thinking about that issue?
So the first one on commercial debt, business debt generally, it's kind of been moving sideways as a percent of GDP, so you don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we're well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small size banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring. And, you know, I'd say we're on the case, so.
A vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak-up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation. And that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right, so much of intermediation has moved away from the regulated banks really for a long period of time. And we got to keep an eye on that.
Chair Powell, you've told this committee that our financial system has proven resilient through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. And that's what the former one, Vice Chair Quarles did, and that's Dan Tarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and to me, this just comes under that heading.
And again, I realize that the details of the study haven't been finalized or made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk, and I mean that's a principle that we'll stick with.
We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So core inflation is running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me.
What would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high, and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
There have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking at the
infrequent.
numbers, it actually is pretty black
Alan
and white.
Blinder's written a book on this.
How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase in unemployment?
I would say 4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that. But I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
But I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world mostly with dollars. That's an advantage. There are some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially what we try to control is price stability. And no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to and to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on Matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Yes.
Right. Now, recently, we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the Employment Cost Index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that the overall, all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
Right. I think the larger point here, based on your response to that first question about growth in profits, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes. I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up. As the supply chains get fixed and shortages are alleviated, you will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right. But can you just talk broadly about those two factors, affordable childcare and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation pressures?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's childcare available, which is, I think, kind of self-evident. The second was
impact of immigration.
Immigration, yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000. And a significant part of that has been immigration. And that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2021 and 22 may be alleviating. So that would contribute to that. Clearly, more people. Clearly, the economy is calling for more people with essentially two job openings for every unemployed person, and this can be a source of those people.
Right, and that would reduce the tightness of the labor market and reduce pressures on inflation, right?
May already be doing so.
Thank you.
About climate stress testing. I just want to ask you this. If we're going to go down that path, if the Federal Reserve is now going to become part of the Federal Climate Police Force, are we going to consider the ramifications of having entire communities and economies, factories and manufacturers, whatever, energy entities, large server farms, leaving them susceptible to a very unreliable, very expensive energy source? Is that part of the stress test?
No, those are considerations for elected people, not for us. We have a narrow role to play here, but it's a real role, and I can talk about that if you'd like.
Well, yeah, I would like you to, because again, if we're gonna start doing stress tests for the 6 largest financial institutions related to climate, which really is more weather than climate, then are we going to consider the effects of an unreliable energy source at several locations throughout our country?
So our only focus is on the safety and soundness of these institutions, and do they understand and can they manage all of the risks that they run in their business model. That's our only goal. We're not looking to be climate policymakers. Climate policy is clearly going to have effects on regions, on companies, on individuals, on countries, disparate effects, and that is not for unelected people like us who have a narrow mandate. But I think it does touch climate, and you're right to be concerned that we find ourselves on a slippery slope. But honestly, I think the climate scenarios are something that the banks are already doing and themselves, and the climate guidance is something that they're looking for. They want to know how we're thinking about this, but we will try really hard not to get on a slippery slope and find ourselves becoming climate policymakers. It's just not appropriate for an independent agency.
So the question is, how much has inflation decreased since its peak?
It depends on the measure, but it's meaningfully, at least a couple percentage points.
Okay, and has unemployment gone down as inflation has gone down?
Unemployment has gone down. Yes, it has, to now a 54-year low.
Yeah, and the question becomes, as you look at the economy and as you try to make the determination whether the inflation is caused by demand or supply, where does all that fall in to your decision-making moving forward?
Well, you mean the level of interest rates. So in theory, there's this thing called the neutral level of interest, and we know it only by its works. And neutral is the level that neither pushes the economy up nor pulls it down. And it changes over time. This is the thing about these important variables in economics. So what's happened until now was that the neutral level of interest went down and down and down to the point where many countries had 0 interest rates and very low inflation. Now we have this a series of shocks associated with the pandemic, and we have rates at 4.5%, our policy rate, and we have the labor market very strong and inflation reacting somewhat, and it does raise the question of where's the neutral rate. Honestly, we don't know. I think we look at the current situation and we see that there's not a lot of evidence hard to make a case that we've over-tightened. It means we need to continue to tighten. I think we're very mindful of the lags with which our policy works. We don't think we need a significant increase in unemployment, and we're certainly not aiming for one. But we do think there'll be some softening in labor market conditions to get to 2% inflation.
We compare with our interest rates here as with, say, Europe?
We're very close to where Canada is. We're a little bit higher than where Europe is. Europe's traditionally had much lower inflation. They now have very high inflation, and they're still increasing rates, but they're a bit lower in terms of rates.
So if we do not get the inflation under control, and like I said, I think the steps you've taken have been reasonable and measured. If we don't get it under control, what are the impacts of that?
Well, the social costs of failure is one way to think about it, are very, very high. So if inflation were to continue, at some point that will become the psychology. People will come and businesses will come to expect high inflation, and that will make it more self-perpetuating. That will mean an up and down economy. It'll mean it'll mean something that looks more like what we've seen in periods of high inflation. Capital allocation is difficult in a world like that. It's not a good time for the economy. What we want to do is restore price stability firmly back at 2% so that we can have the kind of strong labor market for a sustained period that we had before.
You're raising interest rates to combat the inflation we've seen in the economy over the past few years. Is that correct?
Yes.
And although this is the domain of Treasury, a higher Fed's fund rate will mean higher borrowing costs. Is that correct?
Yes, all else equal.
Chairman Powell, do you believe that European and American inflation would have been manageable if not for American energy producers?
I certainly think that particularly our natural gas assets have helped Europe make the transition.
Any sense of how much worse the global energy picture would be if you would imagine a world where we're not producing and shipping energy to other countries?
It'd be hard to estimate.
Probably worse.
Yeah, I mean, I think it's been clearly Europe has managed better than expected, and a part of that story is just U.S. energy experts. Also, the winter wasn't as bad, and the Germans made some good decisions.
So, Chairman, how do the Federal Reserve economists and leaders think about the balance between keeping interest rates low to spur that affordable home building and home buying while addressing inflation?
We have a dual mandate from Congress, as you well know, which is maximum employment and price stability, and that's really what we take into account. We don't, and of course, interest-sensitive spending is the thing that gets the most support when we cut rates, and the thing that is most affected when we raise rates, and that means housing to a significant extent. That's not a choice that we make. That's just the way it works, and we only have really one tool, which is monetary policy. So, you know, we don't really try to use our tools to affect broader housing policy, but really just to achieve our statutory goals.
It happens to just unfortunately be in effect as you try to achieve your statutory goal. Is that?
Yes.
Yeah.
Yes.
And so I want to have you have the opportunity to address Senator Warren's conversation with you earlier about the tools that you have and the impact it has on causing potentially more people to be unemployed, and this obviously has an impact on their ability to afford homes as well. Couldn't you address that?
I'd be glad to. I want to be clear that we do not seek, and we don't believe we need to have a very significant downturn in the labor market. And it's not just hope. I think if you look at the situation in the labor market, you've got all these job openings, and in principle, you could reduce the job openings without seeing a really significant increase in unemployment. Also, you're starting from such a strong labor market. It seems as though you're a long way away from anything that looks like a recession, just looking at the labor market by itself. So, honestly, we don't know that we need that there will need to be a really significant downturn. Other business cycles had quite different backstories than this one, and we're going to have to find out whether that matters or not. But I do think that, and I've said all along, and my colleagues and I have too, that we believe that there's a path to restoring 2% inflation with less significant effects on the labor market than have typically been seen in downturns.
For the general public, for those working families of people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another.
How does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not it's not obvious how that is, but 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So having a 2% inflation goal, which we had for many years, de facto we had it, then we formally adopted it in 2012. But for years before that, we were effectively targeting 2% inflation. And what that meant was that inflation, it's one of the reasons why inflation was low and predictable, is having a real target and sticking to it, not changing it, at convenient moments. So we think it's really important that we do stick to a 2% inflation target and not consider changing it. We're not going to do that. It just is, people will be better off if the whole question of high inflation is just not part of their lives. That's kind of the definition of price stability, is if people live their lives without having to think about inflation all the time.
Do you think about the costs of borrowing for the United States itself?
No, we do not, and we're not going to. In other words, that would be fiscal dominance. If we were, constrained in our monetary policy by the budgetary situation of the United States, and we're not. We're clearly not. The path we're on is not sustainable, but the level of debt that we have is not unsustainable. Is sustainable. Put it that way. So we don't think about interest costs when we make monetary policy. We think about maximum employment and price stability.
It's your opinion that the level of debt we have is sustainable?
Yes, I mean, we could clearly we have the largest economy in the world. We can service this debt. That's not the problem. The problem is that we're on a path where the debt is growing substantially faster than the economy, and that's kind of by definition, in the long run, unsustainable. And the way countries have gotten or fixed that is with longer term programs that have bipartisan support and that address the actual problem in the budget. That's really the formula.
Does the January 3rd statement mean that the Fed has decided that stable coins on a permissionless distributed ledger have no place in banks?
So I think that there are real concerns about permissionless public blockchains, and the reason is that they've been so susceptible to fraud, to money laundering, and all of those things. So I think what you heard from the federal banking agencies in one of their reports was that they would tend to look at those as not consistent with safety and soundness.
And what about properly regulated stablecoins? Do you think they could have a place in our banking system?
I certainly think that in a world of appropriate regulation, where the same activity, where stablecoin activity gets the same regulation as comparable products in different places, then there certainly could be a place for stablecoins in our financial services sector.
Thank you. Is the United States in danger of being a rule taker, not a rule maker, when it comes to digital assets?
I do think it would be important for us to have a workable legal framework around digital activities. I think that is important, and something Congress, in principle, needs to do, because we can't really do that.
Yeah. So my question is, what does the rest of the world know about digital asset regulation that we do not, that the Fed does not?
So as we discussed, this is an SEC staff accounting bulletin, and it's not something that the Fed issued, and I'd be loath to comment directly on it.
So I think, Chair Powell, you indicated that you expect this new CRA rule to be finalized in the coming months. Is that what you indicated?
Yes, that's right.
And can you just tell us, with the departure of Dr. Brainerd, who will be spearheading the CRA efforts?
So I've asked Vice Chair Barr to be responsible for moving the project forward. Of course, it has to go to the whole board.
Right.
And everyone gets a vote on that, but he'll be pushing it forward.
And the communities that they live in often face some of the worst impacts of climate change and extreme weather events. This isn't social engineering. This is dealing with the actual costs and challenges that people experience because of climate change. So, Chair Powell, can you talk to us a little bit about how you see that change and how it fits with the CRA's overarching objectives?
So I think it fits for the reasons that you said. Honestly, I'm a week or so away from getting a briefing on where the proposal lies, so I'm reluctant to touch on. I mean, I'd rather wait till after I'm fully briefed on where that agreement came out, after the FOMC meeting.
I was wondering if you would just be willing to update us briefly on some of the next steps that the Fed is going to be looking at as you evaluate the resilience of financial institutions with respect to climate risk. There's this pilot project that just was started in January, I think it was, of this year, and I'm curious to know how you see next steps there.
So we're doing really two things. One is we are doing a climate stress scenario,
Yep.
which the banks are already doing, the large banks, the 6 that we're working with, and that's really just to begin the process of understanding the risks that are associated with this over the longer term. They're already doing it, and it's something that there's a lot of learning going on around the world, actually. The other thing we're doing is providing guidance. The banks want clear guidance. They actually want one set of rules globally. The big banks that do business around the world, they're hoping that they aren't in a world where there's just different regulatory regimes everywhere they go. So we're kind of working on that as well.
Can you tell me a little bit about how you're looking at the interest rate sensitive and non-interest rate sensitive readings, and whether the Fed, what sort of Fed actions can take place to avoid a zero landing?
Sure. So on the housing sector, of course, is intersensitive spending is the thing that they're very directly affected by our policies almost right away. And the poster child for that is housing. And so you've seen mortgage rates now go back up over 6%. You've seen housing starts come down. Activity in housing has declined as people are reluctant to get out of their the low rate mortgages they had before. So housing activity is slowing down. On the other hand, housing prices went up in the aggregate more than 40% since the beginning of the pandemic. So we may be seeing some price correction on that too. So that's coming along. And housing inflation, which is a big part of the CPI, a little bit smaller part of the PCE, the inflation measures we follow, or we rely on, that will be coming down because of the slowdown in the housing market. I guess I would say the service sector is probably less interest sensitive than that, and that's restaurants, it's travel services, travel and leisure, it's healthcare, it's financial services, healthcare services, all those services, and that's a big part of our economy. This sector is 54%, I guess, 56% of consumer spending on non-energy and food. So it's very important, and it's about having a little bit softer demand and about having some softening in labor market conditions. We think our tools will work on that, but we do expect that will take time.
What concerns, if any, do you have about the capital that we see out there already?
So I supported all of the capital raising that we did. I joined the Fed in 2012, and we were in the middle of implementing all those Dodd-Frank increases, and I supported all of them. After careful thought and discussion with my colleagues, I think the new vice chair is doing what new vice chairs do, which is to take a fresh look and ask the question, even though I think we all agree capital is strong, certainly the vice chair does, the question is it at the right level? And I think that's what happens with a new vice chair for supervision. We don't have any proposals yet, but at some point we will.
Does the Fed consider the bipartisan passed Senate Bill 2155 as superior to any of the Basel requirements or any holistic review process? In other words, it is the law of the land. How does that weigh into how these reviews go?
So 2155 was, I think you're talking about tailoring. So Dodd-Frank actually called for tailoring, and what 2155 did is it said changed may tailor to shall tailor, and it also changed the thresholds. Yep. But tailoring is an absolutely bedrock aspect of our bank regulatory system, and anything that we do is going to reflect what we think is appropriate tailoring between the different sizes and risks of the financial institutions that we supervise and regulate.
And those sort of holistic reviews may actually result in increasing capital requirements for two banks that look like peers, but not for another because of the inherent risk associated with their business focus. Does that make sense?
To your earlier point, though, the law, the Dodd-Frank language, and as amended, actually requires that we take those things into consideration. So we certainly will. We will.
How are the Fed's actions helping that family afford a home?
Our mandate is to provide maximum employment, use our tools to foster maximum employment and price stability. And we're using those tools really now to restore price stability at a time of the highest inflation in 40 years. I think that the same people who are having high mortgage costs, if they have a floating rate mortgage, are also experiencing high costs for all the basic necessities of life. And one of our most fundamental roles at the central bank is to keep price stability. So we have to prioritize that in what we do.
Yeah. How does the Federal Reserve consider the total price of home ownership, including costs of mortgages, in executing that mandate to keep prices stable?
Housing inflation is a very important component of various inflation indexes, and the way that's calculated is the economists look at rents, and then for people who own a home, they impute a rent depending on the value of the home. So it actually does factor in, and I would say the measures of new leases that are being signed and new housing prices show significant declines in inflation, not in price, but in inflation. And that will play through so that overall inflation over the course of the next 6 months or a year will decline.
If we're seeing mortgage rates go up, yes or no, does this discourage folks who may have a low interest mortgage rate from putting their home on the market and then possibly paying double the cost on a mortgage for their new house?
It certainly could. People who are in a low mortgage, a fixed rate, low rate mortgage, I would assume many of them are not moving.
Yeah, does raising the federal interest rate change the cost of borrowing for a company hoping to develop new housing?
Yes.
Does it make it more expensive for suppliers to finance expanding production and meet supply needs?
It does.
Does it give businesses less wiggle room to offer higher wages and attract qualified workers?
Indeed.
How is the FOMC assessing the economic impact of the war and the range of potential outcomes in order to inform how it sets monetary policy?
So the principal, I guess there are two things to say. One is that the principal way that the war has affected our economy is really through commodity prices, grain and particularly energy prices. That's the main thing. I think really, and those have both flattened out. Energy prices globally have settled down and they're at a higher level, and and food prices as well to some extent. So the second thing I would say is that it represents a significant risk. So the war in Ukraine, the outcome is uncertain, developments there are uncertain, and you have to think of it as a source of potential risk to the global economy and to our economy. We don't, and we look at alternative scenarios and things like that. We don't really do it from a geopolitical standpoint, but we do, of course, model scenarios where commodity prices are higher and things that would look like what could happen from Ukraine.
Some economists are currently saying they see no landing right now, that growth is actually accelerating, and that more aggressive actions will be needed to get inflation under control. If true, that would be problematic. What do you think about that assessment?
Well, as I mentioned earlier, I think if you look at the data that's been coming in since earlier this year, you have seen stronger labor market conditions, higher inflation, stronger consumer spending. And also we saw some of the low inflation readings from the fourth quarter of last year revised away. If you take all of those, they may be to some extent related to things like seasonal adjustments or a warm January, but nonetheless, they all point in the same direction, and they do suggest that the possibility that that ultimately would need to raise rates higher than had been expected. Of course, we have 2 or 3 more very important data releases to analyze before the time of the FOMC meeting. Those are going to be very important in the assessment we have of this relatively recent data. We'll be looking carefully at that, and all of that will go into making the decision, which we have not made, but making the decision that we'll make about what to do at the March meeting.
Well, thank you. On February 23rd, the Fed, the FDIC, and the OCC released another joint statement on crypto assets and liquidity risks posed to banking organizations. It's clear that regulators see undue risks for banks in the current environment and are taking a more conservative approach. Do you believe these risks are inherent to crypto assets and how they behave, or are some of the risks a product of the current regulatory and policy landscape for crypto assets in the U.S.?
So we're seeing, really, in the last close to a year now, we've seen just a remarkable set of events in the crypto space. lots of companies collapsing. We've seen massive fraud. We've seen all kinds of things. I think, you know, we have to be open to the idea that somewhere in there is technology that can be featured in productive innovation that makes people's lives better. However, in the near term, we see in crypto activity lots of things that suggest that regulated financial institutions should be quite cautious, and that's in doing things in the crypto space. And that's what we've issued 3 or 4 releases to the banks, along with the OCC and the FDIC. The Fed has. And they essentially say, you really need to be careful here. You need to be careful. It's early days with crypto. There isn't the appropriate regulation. We're learning lots about the risks, and they are many of the same risks that run in other parts of the financial system, but without appropriate regulation.